Hey everyone, welcome to the series How Indian Equity Markets Are Changing. India is growing faster than ever, and there are various internal changes that are happening in the background to stabilize the Indian equity markets. And the reasons I'm going to list today are some of the main important reasons why you should have some exposure in Indian markets. In this series, we are going to discuss and understand various factors contributing to India's growth story. I have the first chapter as retirement funds. So to understand the very first factor, I have to take you back to 1978. In 1978, US introduced the concept of 401k plan under Revenue Act, and that was implemented in 1980. At this point, employees could contribute through their yearly bonuses. Later, this model was revised as funds didn't see much inflow during the first 2 years. Also, from a people point of view, it wasn't that lucrative. After this new change was introduced, where employees could basically contribute on a weekly basis through their paychecks, and it became more lucrative as more and more people started to put their money in their 401ks. And if I have to take the fast forward story, within 10 years from the day 401k plan was started, which is in 1990, 401k funds asset under management was close to $380 billion. And in 1996, fund touched $1 trillion asset under management. If you have to make a guess, this currently sits close to $7 trillion asset under management. Official numbers from September 2022 is about $6.3 trillion asset under management. More or less, these 401k funds represent close to 12 to 15% of total market cap of the US markets. During this period, there was a massive 20 years of bull run from 1980s to 2000 in retirement funds. As you can see, 401k funds played a major role in stabilizing the markets during this 20-year massive period. Now you ask me, where is India in this process? Let me tell you what's happening in India right now. India is now on a similar path with their National Pension Scheme, NPS, which has been made more lucrative by enhancement of tax exemption from 40% to 60%. For lump sum withdrawal on closure of NPS account at the time of retirement at the age of 60 and can be extended up to 70 years. What it means basically is what you could withdraw earlier without paying taxes was only 40% of your total retirement lump sum. Now, from 2019, you can withdraw 60% of your total retirement lump sum without having to pay any taxes on it. So that basically created a ripple effect or a snowball effect, if you want to call it. So if you look at the numbers on NPS right now, from the day we started to see some sort of inflow. So I'm going back in 2014. In 2014, this fund was only at $6 billion asset under management. This later changed pretty quickly in 2019. And by the way, 2019 is when the change in tax exemption policy happened from 40% to 60%. And that's where more and more funds started to flow in. And if you have to take a spot number for 2019, it was at $36 billion asset under management. As of August 2022, we are currently sitting at $100 billion asset under management just for NPS alone. So there's another retirement fund that private companies offer to their employees, which is Employee Provident Fund. As of August 2022, EPFO was sitting close to $250 billion. And by the way, you have to remember, EPFO, not the entire amount is flowing into equity markets. Only 10 to 15% of that flows into equity markets, and the rest 85% goes to debt instruments. So net, we are sitting at $350 billion mark, and this $350 billion mark is very similar to what we saw in the US in 1990s, where the 401k fund was sitting close to $380 billion. And what happened prior and what happened after was a massive bull run between 1980s to 2000s in the US markets. So this huge bull market, we are already close to 10 years in India's bull market, and I expect India to run another 10 years overall. And during this bull market, which happened in the US, as you can see, 401k funds played a major role in stabilizing the markets during this 20-year massive period. If I have to give you a perspective on how big these fund flows are, you have to take total market cap of India, which is closely less than $4 trillion, and out of which $500 billion are coming from the mutual fund industry, and the retirement funds which are flowing to the market is $140 billion, as EPFO, not entire amount is coming to equity markets. So another interesting point is from 2012 to 2022, mutual fund industry grew from $90 billion to $500 billion, almost fivefold in 10 years. If I have to tell you, for NPS, we were sitting at $6 billion in 2014, and the total asset under management that NPS is sitting at right now is slightly over $100 billion or close to $130 billion, if I have to take a number, in August 2022 for asset under management. And total overall retirement funds that we have is close to $350 billion. And again, this took less than 10 years to accumulate. So all the retirement fund money, this money is doing nothing but providing stabilization to Indian markets. So even if foreign funds start to pull their money, or we see a lot of outflows in the market is not going to give rat's ass about anybody or anybody's mother's money, because these retirement funds are not going to sell unless there's a crisis, of course. But these funds are there to provide long-term stability. So this was the first chapter on the series, how Indian equity markets are changing. I'll see you for the next chapter very soon. Thank you all for listening.